With chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's going crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Financial Advisor at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, February 9th, 2024. If you think I sound bad, it's because I feel bad. So it's not a distortion of your sound system. Yours truly is under the weather. But I am under some nice weather. I have not come back yet from vacation. So the weather's in the 70s and sunny, but I am well under it. A little shout out to Robin and Marcia and Tom and all the folks that have touched base over the week. Appreciate hearing from everybody. Let's go ahead and jump into the numbers, kind of tell you what is going on. Markets clawed their way higher this week. And I tell you, they had to claw their way because the great Fed chair there, Jay Powell, was on 60 Minutes last Sunday night and really talked things down when it comes to lowering your interest rates. And the market didn't like it. So Monday opened up and market was down significantly. It looked like it could be a bit of an ugly week, but it found its footing. It turned around. Dow Jones ended up flat on the week. The S&P 500 ended up 1.37%, and it broke the 5,000 level, closed over 5,000 today. That's not a big deal. There's no magic about the number 5,000. It's just kind of like a big round psychological number. 5,200 is actually kind of what the upper limit of what we're looking for out of the market in the short term or medium term. But it did cross 5,000. People will like that. NASDAQ Composite up 2.3%. And the Russell Small Cap Index finally getting some traction, up 2.4% this week. So good to see that moving. The Volatility Index, of course, we look at that. That's a measurement of expected volatility, looking out 30 to 45 days in the market. And it was down 6% on the week. So things looking pretty tame there. Looking at long-term bonds as measured by the TLT. That's a basket of 20-year treasuries, down 2.3% on the week. It's down 5% on the year. It was down last year significantly. It was down big time the year before. So this particular investment, this area just can't get traction. And a lot of that was because the market was expecting rate cuts to begin in March. And they didn't believe the Fed, I guess, last week when they had their meeting, but they believed Jay Powell on Sunday night because now the market's really repriced those expectations. Of course, we told you coming into this year, the market was expecting 6 rate cuts beginning in March, and we said, forget about it. It ain't going to happen. We were pretty definitive on not believing that was going to be taking place. And it looks like the market now is kind of coming around to our line of thinking. As a matter of fact, the market now doesn't even really expect a great chance of a rate cut in May. I think if we get them, if the economy continues to stay anywhere near as strong as it's been, the Fed's got no reason to cut rates. Why cut the rates if everyone's still going on and doing their thing? If they're buying houses and shopping and spending money, these are things that the Fed doesn't really have to be overly concerned about. And you cut them too soon, inflation comes back, and then you've got a really big problem on your hands. So I don't think the Fed's going to be all that anxious to do so, but we'll see. I'm expecting maybe 2 or 3 rate cuts beginning last half of the year. The market seems to be finally coming around, though, to reducing those expectations, and therefore bonds came down a bit this week. When you take a look at the sectors of the market, semiconductors had a monster week, up 6.6% this week. A couple chip companies reported with some really good numbers. Retail sales were up a bit. Discretionary is up 1.4, healthcare up 1.4, materials up 1.1, technology up 2.7, mainly driven by those chip companies. And then on the downside, sector-wise, utilities down 1.9, staples down 1.4, energy down 0.2%. And actually, I tell you, utilities are starting to look pretty attractive to me. You know, we don't have anything in the way of utilities right now. And you would think, well, gosh, David, why not? Shouldn't you have some money there? Yeah, but the problem is in coming into 2023, last year, utilities were stupid expensive. Everyone tried to hide out, and utilities and staples in 2022 in the market and the bond market were both so bad. So those stocks were ridiculously expensive coming into 2023. So we eliminated them from our models. I just didn't see the reward there. And they did. They had a miserable year last year, down double digits. And now they're down 4.8% year to date. But they're good companies, right? I mean, American Electric Power, stuff like that. I mean, these are good looking companies that paying good dividend yields and whatnot. So these are things that I'm watching and looking at, areas that we may want to try to pick something up. Just kind of keep my eyes open on those types of things. And then look at some other stuff. You got gold down 0.5% this week, silver down 0.3%. They're not doing anything yet year to date either, both down. So what moved markets? Well, I told you already about Jay Powell shaking things up here beginning of the week. And then earnings continue to come out. They've been decent. Market's been responding positively to that. But really, I have to tell you, I thought the market would react a little bit more negatively, a little bit longer regarding the idea that rates aren't going to come down anytime soon. So I've been a little surprised at the resiliency of the market in that regard. We've done some trimming this year, as you already know. I want to do some more. I trimmed some Facebook, Meta, before earnings. And then, of course, it has shot up after earnings. It went up a lot more. And I want to trim it again. Honestly, it's up 32% year to date. But I can't do it yet because they're going to pay a dividend now. And if we own the stock as of February 22nd, I think it was, I checked my notes, then we get the dividend. So I'm going to hold off trimming that back until after we're eligible for that dividend payout. But we've been doing some trimming. My expectation moving forward this year has been that the market's going to be sloppy and going to move around a lot and maybe not yield a huge return. I saw a report yesterday. It's really interesting to me. It went back and looked at all the times throughout history where the S&P 500 was within 1% of its 52-week high, yet 60% or less of the stocks were above their 50-day moving average. Now, I'm not trying to take you into the weeds, okay? 50-day moving average is nothing crazy or technical. It's just the average price of a stock or of the market over a 50-day period. The big ones everyone watches in this business are the 50-day moving average and the 200-day moving average. Okay, you've probably heard me say over the years, nothing good happens when the market's below its 200-day moving average. This is an area that everyone watches. And when the markets are strong and healthy and really looking positive for a longer time moving forward, we see really good breadth. Okay, we see a lot of the stocks within the market above their 50-day. Right now, we don't have that. Okay, we do not have that. We're about that 60% mark. As a matter of fact, I mean, half the stocks in the S&P were down year to date at the close of January. I think a lot of them still are for the year to date. Even though the market's up a few percent, a lot of the stocks within the market are negative on the year. So when they looked at these numbers, when the market was within 1% of its 52-week high and less than 60% above their 50-day moving average, you look at 1 month, 3 months, 6 months, 12 months, and the returns were anemic. The market was up at a year later 64% of the time with an average gain of 5.5%. So that doesn't surprise me. I mean, this market feels a little tired, if you ask me, just the way I've been watching it. I see a lot of red on the screen every day. Even though the market's been trying to push higher, there's always a lot of red. So it just feels a little tired to me. Doesn't mean it can't go higher. I think I mentioned earlier, I think up to 5,200 is certainly possible. But nonetheless, it can be a 3 steps forward, 2 steps back kind of year. So one of the things we're focused on is yield. That's why I mentioned utilities a moment ago. I've got my eyes on utilities, maybe pick up some more dividends. That's why we had that meeting with Mark Bashalo from Manning & Napier High Yield Bond Fund, highest rated bond fund in the country by Morningstar, and had some meetings with them and decided to allocate a lot of capital there to that fund. It's paying 8.5%, right? And I like that. I think in a market, in a year where you can't have the same level of upside expectation, it's good to make sure that you're going to have some return coming from somewhere. And that's why we've increased the yield in the portfolio and looking to do some more of that. So whether that's in the form of utilities, maybe adding some more to those high yield bonds, I'm just kind of looking through things and making the decisions as we go. But when I do some trimming, I'll be looking to allocate that capital. I'm going to be looking to probably focus a little bit on yield, just to make sure that we're not so dependent on the S&P continuing to climb a whole lot. The market's looking a little expensive right now, just so you know. As of right now, expectations for earnings this year look to be around $240 per share on the S&P. $240. Well, the S&P just hit 5,000. So you do some math, okay? 5,000 divided by 240, that's a multiple of 20.8, All right. That means you're buying 20 years worth of earnings today when you buy the S&P 500. 21 almost. That's a little bit on the expensive side. I don't really see a whole lot of catalyst for earnings to go up that much more. And if they don't, the market's just going to be getting more expensive if it continues to go higher. That's why you want to depend on other areas to make money. So look, I'm going to go ahead and wrap up. But between now and next we meet, as you're thinking about your future, your long-term goals, all the things you want to do with you and your money, maybe it's find a cure for whatever ails me. If you do, please send it my way. Maybe it's buy a second house, retire a little early, take that big trip. You know what your goals are. Don't just think about them. Think big, think B-I-G. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.